Good morning, good afternoon, good evening, wherever you're listening or logging on from, or even watching in the world, because we know we always have a number of international visitors with us for what is today the 8th in our series of infrastructure intelligence webinars, where we're focusing on COVID recovery and the implications for our industry sector. Last week, we looked at the very interesting and crucial issue of delivering the public sector pipeline after COVID. And this week, we'll be looking at delivering the private sector pipeline after COVID. There's obviously been a lot of talk about government investment, but clearly there is a connection between the two, between the government financial impetus on the one hand and the ability of the private sector to actually deliver on some of the infrastructure plans that are going to be outlined. As always, we've got a brilliant panel this morning to hopefully shed some light on these issues from Arcadis, from the British Property Federation, from the Scottish Futures Trust, and also from Barton Willmore, who we're also grateful to for sponsoring this series of webinar events. I hope it's going to be a really good discussion today. If you do have any questions for any or all of our panelists, then please post them in the questions box that will be on screen on your GoToWebinar dashboard. If you want to put your company name down there as well, I'm more than happy to give you a bit of a name check if that's what you want. You don't have to do that, but please feel free to do so if you wish to do that. Anyway, that's enough from me, Andy Walker, editor of Infrastructure Intelligence, and we're going to go to our first speaker at today's webinar, and that's Ian Fletcher, who's the Director of Policy for Real Estate at the British Property Federation. And the BPF is the trade association for the property investment sector, and Ian speaks. Team at the BPF cover a wide range of commercial property, sustainability, planning and housing issues, and I'm sure that he will be able to shed some very interesting insights on this whole issue of delivering the private sector pipeline after COVID. So Ian, the floor is yours.
Thank you very much, Andy, for that introduction, and good morning to everybody that's on the webinar today. I'm going to talk about three things today. The first part is to look at the property investment sector and how that's really changed. I've used a sort of reference point of 2008, just before the previous global economic slowdown, to illustrate how I think the sector is perhaps a bit more resilient in terms of pipeline than it was back then. Second part of my remarks are going to focus on a survey that we did of clients, 29 clients, looking at the current financial year and how their intentions have changed in light of the current outbreak. And then thirdly, a little bit about solutions, drawing on our recovery plan, which is a document called Building a Shared Recovery, and also some references to the Construction Industry Task Force, which I sit on and have been meeting daily up until a few days ago. So first, property investment sector and the changes within it. I've taken as my reference the MSCI index. That's well known as something that most of the large property investors contribute to, and looked at how the index has changed in terms of value, property value, between 2008 and now. So back in 2008, 47% of the sector's investment was in retail. Today that figure is 32%. Shopping centres alone was 18% back in 2008, now 8%. Offices 35%, now 24%. Industrial back then 14%, now 24%. And alternatives, which is a particular part of the sector that I do a lot of work on, which includes residential, student accommodation, leisure, healthcare. Back in 2008, very little investment, 4%, now 19%. So that shows a significant sort of switch in investment intentions away from offices and retail towards more industrial and alternatives. I think who's investing in the sector has also changed quite significantly. A far broader range of sovereign wealth, private equity, and pension fund managers investing in property than there was even back then, as well as the long-standing investor developer companies that people will be familiar with. To just sort of illustrate the points of change, I've drawn on sort of three sectors and just looked at them in a little bit more detail. So the first was that I just looked at that MSCI index and particularly the property companies. And if you looked at the 30th of June this year, yes, there are familiar names, the Segros, Land Securities, British Lands, Derwent, all in the top four there. But then the next 5 or 6 are probably property companies that wouldn't have featured at all in 2008. So you've got people like Unite investing in student, Tritex Big Box, REIT investing in industrial, Granger, big investor in build to rent, and then a couple of healthcare investors, primary healthcare property and Assura. Honing a little bit more on build to rent, and as I say, a particular passion of mine, didn't even exist in 2008. We did a lot of work in the previous recession in 2012 with government to really kickstart that sector. If you looked as of today, there are 122 build to rent schemes with planning permission that are due to complete in the next 18 months. So a substantial pipeline. Most of those developments are on site or back on site if they temporarily paused. That 122 schemes delivers 44,000 units. I'll do the maths for you. That works out at about 360 on average units per scheme. So sizable schemes. Estimated pipeline of 7 billion. And looking further ahead, very healthy pipeline, particularly out of London actually. Build to rent has become a phenomenon that sort of started off in the outer ring of London, has reached out into the core cities, but now is being seen in, like a better word, secondary cities across the UK, everywhere from Dundee to Swindon, Plymouth, Brighton, lots of other sort of provincial cities. Final sort of dip into some stats was just to illustrate how the industrial sector has been affected by events over the last few months and its growth. So first half take up of sheds in 2020 was the best ever recorded. That's not surprising, bearing in mind all the online groceries we're all ordering and various other deliveries that we're getting. 22.4 million square feet, according to Savills, which is 38% above the 2019 figure and 66 above the long-term average. And development, I should say actually that of that, 35% of that take-up was Amazon. So there's one big buyer out there that's obviously consuming a lot of space at the moment. And then development announcements were the second highest on record in quarter 1 of 2020. A little bit of a slowdown taking account of conditions in quarter 2. But that sector looks to be very strong going forward. Pause there for a second because I want to sort of segue into the second part of my remarks, and that survey that we did of 29 clients. And as I say, that was done about 6 weeks ago. Questionnaire, and we'd asked them to indicate how their intentions had changed over the current financial year, so sort of April to April next year. 18 private sector clients and 11 of the top 12 housing associations. And the headline figure was that private sector spend was looking at a correction of about 30% down on what it would have been if this had been a normal year. Some of that was timing issues, so it wasn't spend that was going away, it was just not going to be spent in this financial year, and that was a reflection of trying to maintain productivity with social distancing, projects being delayed and starting late, and therefore that spend would carry forward into the future year. there was not a lot of exposure in that sample to retail, and I think generally our members are not investing heavily in retail for obvious reasons at the moment. Much of the retail was only coming through in terms of mixed-use development. Biggest loss of the private sector pipeline was in office development. I think 9 of the 29 were substantial investors in office and trimming back plans. Residential rented was holding up better, but suffering probably more than most in terms of productivity issues. And the distribution sector hardly changed at all. Intentions and what they planned at the start of the year almost matched. And then there were some smaller sectors that had also been badly affected by current conditions. So things like hotels, student accommodation, where significant impact on occupancy of lockdown was meaning that they were, I suppose, retrenching and being very careful about their capital spend and their general cash flow. Final part of my opening remarks was just I'd wanted to finish on focusing on some solutions in terms of trying to ensure that the private sector pipeline continues to be delivered. And as I say, I've drawn on our recovery document and also the Construction Industry Task Force. I suppose my first reflection is it doesn't feel a lot like the previous global economic crisis. That was a banking crisis fueled by crisis in confidence in property values, and this is very much a health crisis with economic consequences, and those economic consequences I think are quite different for different subsectors. So when we're looking for solutions, I think we have to think about more targeted solutions towards particular subsectors. Yellow, clearly there are common ones. Future access to development debt finance, maybe one of those. And I also think the sector is generally well capitalized. Clearly in any recession, access to development debt is one of the things that can potentially hold up our sector quite significantly. So you're thinking about subsectors, then build to rent, what holds it back, I think, is its newness. It's not reflected in many local authority local plans. So to bring the schemes forward more quickly, you either need to get more of those local authorities, including build to rent, in their local plans, or there has to be some sort of national policy, perhaps linked to brownfield land, that gives build to rent some sort of presumption in favour of it in those circumstances. In current circumstances, the investor stamp duty land tax surcharge also seems a bit of an unnecessary disincentive to investment, which we should be encouraging. I think keeping debt finance flowing to that sector in particular is something that's really important, and the use of government guarantees. We still have 4 billion of guarantees that the government hasn't allocated, and that could certainly be used to good effect to underpin the delivery of debt finance to the sector. Logistics, probably much the same challenge. It's a strategic infrastructure that is often planned at a local level, and that doesn't really work very well, I don't think. And if we want to ensure that pipeline is continuing to be delivered, then a more directional national policy making space for that sector, I think, is essential. High streets, some of the government's recent announcements on the high streets, obviously quite positive. High street use allowing greater change between different uses, demolition and rebuild. I think we'd like to see we've mooted town centre investment zones. I don't think, given the scale of challenge on the high street, that one bullet is going to do the job. And if you want to repurpose and reconfigure high streets, you really need to be concentrating a number of initiatives in the one place. I think in terms of offices and student accommodation, actually the thing that seems to be holding them back most of the moment is just clarity about occupancy, and we seem to be edging there in terms of when will people get back to work. In student accommodation, greater insight into what the academic year 2020-21 is going to look like. I think a consequence of the current crisis is that in offices people will probably take less space, but they'll trade that off against perhaps better quality. And so in current circumstances, some sort of targeted tax relief that encourages refurbishment and environmental improvement, I think, would be something that would be really helpful. And then for the sector as a whole, one of the things that we've pushed and is about to become law, I think, next week through the Business and Planning Bill is just ensuring that planning permissions are extended. We don't lose those. For larger developers, which our members are, they tend to use an outline permission and then a number of reserved matter applications. So it's particularly important for them. And then my final word about the Construction Industry Task Force. It, as you probably know, has published a very comprehensive roadmap to recovery that seeks not only to sustain the sector in the short term, but to continue to modernise and deliver on a number of the sector's long-term challenges that the Construction Leadership Council have been working on for some time. I've had, as I said at the start, the privilege of being on their daily calls, and I have to say, it's one of the most fulfilling things I've done in 20 years in the sector. There's so many on that task force that I think deserve huge credit, but hats off particularly to Andy Mitchell and Mark Reynolds as co-chairs. And also, civil servants don't often get, I don't think, the praise they deserve, but they've really sought to facilitate the sector's continued operation south of the border, and obviously successes, I think, are well publicised in terms of the various iterations of site operating procedures, extension to construction hours, credit insurance support, just keeping more generally the materials pipeline functioning, and the latest proposition, which is a talent retention scheme, and much more besides. So it's been a swift tour of the three things I wanted to discuss about, and thanks very much to your audience for listening to me today.
Thanks very much, Ian. Again, some really interesting points there. I think it's good to get those insights, from your members in relation to how they see the market developing going forward. I mean, obviously, this is a major crisis that we've seen from a health perspective, but as you correctly point out, with some quite serious economic ramifications, and ramifications that we probably haven't seen the worst of yet, quite frankly. And obviously that's something that we will be looking at over the course of this event and the subsequent events that we've got left in our webinar series. I think it's also interesting what you were saying around the government's role in creating, I suppose, a fiscal and a planning sort of climate regime, if you like, that will facilitate recovery within within the sector, and I'm sure some of our other speakers today will perhaps comment on some of those issues. But thanks for the moment. A quick reminder to our audience to keep your questions coming, post them in the questions box so that we can fire those at our panel later on. Our next speaker is from one of the UK's, indeed one of the world's leading design and engineering consultancies, Arcadis, and we're very, very fortunate today to have their managing director for buildings with us, Edel Christie. Edel has a wide experience within within our sector, and I know she's very passionate about the industry. She's passionate about the people that work in the industry and what the industry can actually do to influence people's lives as well. And I'm sure that what Edel has to say will be extremely interesting to this audience as we continue our discussion on this important issue of the private sector pipeline. So Edel, it's your turn next.
Hi, thanks Andy, and thank you for everyone joining today. Following on from Ian's share there, I'm going to focus a little bit more from pipeline into the delivery of the pipeline across the UK. And I'm going to start with, unfortunately, we do expect the private sector to bear the brunt of any post-COVID slowdown. First of all, a view on the economic and social infrastructure spend is likely to rise as part of a long-term investment in regional productivity and responding to that levelling up agenda and decarbonisation. We can see, as Ian has shared, the sector-specific sources of demand that have been inevitably hit badly by the short-term behavioural changes that we're seeing, in particular universities, retail, hospitality and indeed offices. Lenders and investors are most definitely tightening their terms. Main clearing banks are reported to be open for business, but they are very selective on sponsor and asset and very likely to be at reduced leverage and increased margins. And we can also see there is a flight to quality focus across the market, with many lenders responding to a price discovery stage where they'll pause to consider how to put risk into the current market. But I'm also pleased to say I don't think it's all doom and gloom. We think that the smaller cities and towns that have a telecommute are going to benefit from city dwellers banking on a future of flexible working, and we can talk about that later. We anticipate that radical changes in retail will trigger equally radical thinking in asset management to make creative use from centrally located assets, in particular new cultural health and wellbeing uses. We're already seeing public and private funding sources combine to deliver the next phase of regeneration in regional towns and cities to support the levelling up agenda, and a really good example of that might be the West Midlands. And from a property perspective in particular, a number of large real estate finance deals have recently been announced, showing signs of the market returning, and a good example of that would be down on London's South Bank with JTRE funding a deal of 266,000 square feet. So what do we find? Well, in the short term, many private clients are delaying their project procurements, taking time to take stock and see how the market settles, and allowing the COVID-19 related risks to become better understood. Certainly our private investors in the regulated economic infrastructure sectors, for example water, are sustaining their programmes. They have secure revenue and stretching investment targets, even if COVID-19 disruptions could negatively impact their performance. Private sectors in the open market, however, are dealing with the implications of a very different business environment, and not all projects will be viable as the present. And Ian, I think you shared that in detail across the different asset classes in your share. And regeneration schemes in particular face the challenge of finding the right mix of use to support the post-COVID-19 business case, particularly the ground floor and the purpose of retail as it had been in the past. And we see the hurdles for private investment growing. Certainly there is uncertainty around the assets, more expensive finance, we've seen that go from 300 to 500 base points, and tighter loan to value percentages, greater exposure to delivery risk, and certainly the sharing of COVID-19 costs and time risks in contracts. And I think we saw some shares yesterday on that as well in the CLC guidelines. So we see investors looking to de-risk their investments, looking at traditional routes to procure, as Ian said, new business models like build to rent that focus on longer term income streams rather than the capital return, and greater alignment into the public sector. Regeneration aligned to high speed 2 would be a really good example, or indeed Homes England, the GLA coming together to work on residential schemes to promote housing back in. What we don't see yet are de-risked opportunities for private investors to invest in public assets. Ofgem's draft determination issued last week included a significant reduction in the rate on return of capital. There's been no suggestion from Treasury at this stage that they're planning a relaunch of PFI2, and there's little suggestion that private finance will be used to fund major infrastructure on concession basis. So it's all about solutions, as Ian said. So what do we think is needed to sustain the private investment pipeline? Well, we need progress on de-risking demand, dependent on effective test, track and trace and the early delivery of vaccine to get the industry moving. A transparent and collaborative approach to project procurement, both for contracts that are in play and future projects, so everyone knows what they are liable for and what the risk exposure is and what risk they're actually managing. Continuing availability of multiple sources of finance, both from the private and public purse, so that different options can be explored. And a new approach to risk, including the drafting of contracts as standard. Future risk allocations should be looked at more collaboratively by all parties rather than in silos to help reinforce relationships and deliver projects faster and more efficiently than we've seen prior to COVID. Thank you. Thanks, Andy.
Thanks very much, Edil, for that. Again, some quite important points I think made there, particularly around the risk profile, and because at the end of the day, that's what's going to open up the potential for investment, in the sector. And I think, unsurprisingly, going back to the points that Ian made, you reflected, obviously, a nervousness in certain sectors, which I think is inevitable, given given what we've seen. But also, as well, I think good to say that it isn't all doom and gloom, because obviously what we've seen, with the pandemic, is that as we come out of it, as we assess, clearly that could lead to some quite dramatic changes in working patterns in the new normal that people are talking about, and that inevitably will potentially lead to opportunities within the sector as a result of that. So thanks for that introduction, and again, I'm sure we'll come back to some of those issues in the discussion. Our next speaker is Ben Lewis. Ben is the Infrastructure and Energy Director at Barton Willmore, who do some really interesting work within the sector with a wide range of clients. And I know they've been particularly vocal in the recent period on the need for planning reform in order to free up some of these opportunities that we've been talking about and will talk about on the webinar today. So Ben, it's over to you next.
Brilliant. Thank you, Andy. Thanks everyone for joining us this morning. As Andy said, I lead Barton Willmore's National Infrastructure and Energy Planning team. I work across a range of sectors, but my principal focus is nationally significant energy projects. And it's the private sector opportunity in that sector I'm going to talk about this morning. Now, in my mind, we can't separate economic recovery and the climate emergency, and infrastructure and the private sector's role in that will be critical. Now, this will need a strong supportive policy line from government, together with some public funding. Now, the importance of infrastructure to the UK has been talked about for a number of years. National Infrastructure Commission first highlighted it in 2019, and they also highlighted the private sector's role in its delivery. And importantly, that assessment back then wasn't just about economic growth, it was also about improving the quality of life and hitting net zero. Now, it talked about decisive action, long-term vision, lasting plans, and stable funding. All of these mechanisms provide certainty for investment and private sector delivery. Unfortunately, we're still waiting for the government's response, so much for the certainty, but this is expected in the autumn. Now, when we look at the role climate change can play in private sector pipeline work, the latest annual report to Parliament by Committee on Climate Change set out a range of green stimulus measures which aligned with those previously put forward by the National Infrastructure Commission. Both see the current situation as a once-in-a-generation opportunity, and they've called for deployment of energy efficiency in homes and buildings, rolling out full fibre broadband, expansion of the contracts for difference energy scheme to grow wind and solar generating capacity, electric vehicle charging networks, investment in heating technologies, and innovation in things such as the use of hydrogen for heat. All of these can create new jobs, all will require private sector investment or private sector delivery. So in this context, the private sector pipeline opportunities, I see two main areas I'd like to talk about this morning. One is government initiatives, including the Major Projects Programme, and secondly, the Green Recovery. Now, I appreciate that this is a discussion of the private sector pipeline this morning, but you can't, in my mind anyway, have that discussion without recognising the value of contracts that will come from the public sector. Infrastructure Projects Authority annual report was published last week, provides a snapshot of the major projects portfolio the government has, and there's 125 projects in there with an estimated whole life cost of £448 billion. A month earlier, they published the infrastructure and construction pipeline for the next 12 months. That has 340 procurement contracts across 260 projects with an estimated value of £37 billion over the next 12 months. Now, admittedly, some of the big items are highways, schools and water infrastructure, but all of these will be delivered under contracts by the private sector organisations. Then you have the Prime Minister's £5 billion investment plan announcement on top of that, although a lot of that was probably already allocated at the time those reports were published. Now, moving into renewable energy, it's definitely a quick win. for economic recovery. If the government provides the clarity and certainty we need, this could deliver both private and sector investment and progress to net zero. We're in a position now where electricity demand is increasing exponentially as we move towards 2050, and the power grid may need to double or triple its capacity. And that's going to come through a range of technologies, all delivered predominantly by private sector companies and private sector investment. You only have to look at the Planning Inspectorate's website at the moment to see that of the pre-application projects for the National Significant Infrastructure Regime, over 50% of private sector-led energy projects. Now, the contributions that renewables can make to economic recovery is undisputed. You have research by the Oxford Smith School of Enterprise and Environment found public money in green projects produces greater returns in the short and long term than pouring cash into conventional high carbon projects. Recently, UK 100, who are a network of government leaders pledging to move to 100% clean energy by 2050, found that £5 billion worth of public funds investment in renewable energy could actually unlock £100 billion of private capital, which highlights the connection that Andy mentioned earlier between public and private. So what are the prospects for the renewable energy pipeline? Are they strong? I think they are. This year we've seen records being smashed left, right and centre. We've gone 66 days without coal power. We've seen the highest ever generating capacities for wind and solar, and we've achieved the UK's lowest ever levels of carbon intensity. And while all this is happening, the cost of renewable energy is coming down. So where's the potential? Well, round 4 of the Crown Estates offshore wind leasing opportunities currently in progress. This will see 7 gigawatts of new offshore wind leases against the government's target of 40 gigawatts installed by 2030. The UK already has 10 gigawatts offshore installed and 4 gig in the pipeline. And in the last 12 months, the cost has fallen to less than £40 a megawatt hour, which is considerably less than the strike rate agreed for Hinkley Point C. Solar Trade Associations recently published a report which sets out they think that 40 gigawatts of solar can be deployed by 2030. Now, in March 2020, there's only 9 gigawatts in the pipeline, so that's a big jump. And only this week, renewables investor Thrive has identified a potential £66.5 billion investment opportunity for onshore renewables, including solar, which breaks down to just under £5 billion a year, which could inject £28.9 billion into the economy by 2035, whilst also saving consumers money. The potential's there, but we need a clear and supportive planning and regulatory context to provide the certainty and reduced risk profile that investment decisions require. Thrive highlighted this as a key factor in their report. Positively, we've seen some steps from the government already. BEIS announced £80 million worth of investment to cut carbon emissions, which includes £25 million into heat networks, £24 million to bring down the cost of retrofitting homes. Contracts for difference in the electricity market auctions currently planned to open in 2021 will include solar and onshore wind for the first time in a long time. And just that announcement alone saw the UK move up to 6th place in EY's Renewable Energy Country Attractiveness Index, sitting it behind the US, China, France, Australia and Germany. So that shows the difference government commitment can potentially make. Large-scale energy storage is another growth sector. Batteries this week are being removed from the National Significant Infrastructure Project regime, which is a massive step, as many developers saw the regime as an expensive mechanism. And as a result, I think we'll see a surge in 50 megawatt plus storage projects going forward. We've got the Energy White Paper, the National Infrastructure Strategy to look forward later this year, as well as the Planning White Paper and planning reform that will come before that. Arguably, though, I think we need more. We need up-to-date national policy statements which reflect the energy system we need and the technological advancements that are happening in the sector much quicker than policy can keep up with. We need a context which supports utility scale storage to avoid a situation like we had in May this year, when the renewable generators were asked by the grid to turn off their generators due to reduced demand levels. It would be far better to keep them going to store that somewhere. And whilst onshore wind can participate in the contracts for difference next year, the confidence that you can actually get planning permission for an onshore wind farm in England remains low because the government hasn't removed the legendary footnote 49 from the NPPF. Grid is also a major issue, and it's an area where I think public spending could unlock hundreds of megawatts in the development pipeline. We also need to look at markets for proven technologies that aren't currently coming forward in the UK. European Parliament recently voted resoundingly in favour of a report which described pumped storage hydropower as playing a crucial role in energy storage. Yet that technology currently has no route to market in the UK. We are living in unprecedented times. private sector the private sector pipeline, is undoubtedly there, and I have no doubt that infrastructure will be a central part of that in the future, supporting both economic recovery and net zero. We can have jobs and tackle climate change at the same time, but we need policy, strategies and mechanisms in place to facilitate that. We also need to focus on infrastructure that can be implemented in the short term, such as energy efficiency improvements of buildings, the rollout of 5G, improvements to the transport networks, as there's no doubt these shovel-ready projects can deliver private sector stimulus and jobs. And the government seems to recognise this in the recent £3 billion green investment package announced by the Chancellor for retrofitting homes and public buildings. We also need to ensure that deployment of established renewable energy types, such as wind and solar, is facilitated, which the CFD revisions will do, along with proper support for proven critical technologies like pumped hydro that doesn't have a route to market. In overall terms, I think the pipeline's clearly there in that sector anyway, but we need political support. We need a national infrastructure strategy, which is climate change at its core. Thank you.
Thanks very much, Ben. Some really interesting points there, particularly on green recovery, which I think is something that has been raised during our webinar series, the whole concept of shovel-worthy projects. And it's clear that I think the message is slowly getting through to government. But I think it's interesting that you talk about the importance of having a green recovery, the drive towards net zero, and very much seeing that as part of and a key opportunity going forward, particularly as we look to recover from where we are post COVID. So thanks for those comments there. Just a reminder to people to post any questions that you might have, any of our panelists or the whole panel itself in the questions box, because it'll be the opportunity to pose those questions very shortly. But first of all, we're going to hear from Peter Reekie, who is Chief Executive of the Scottish Futures Trust. And the Scottish Futures Trust has been at the forefront of improving infrastructure, public sector infrastructure across Scotland for more than a decade. Originally, they were established by the Scottish Government as a centre of infrastructure expertise, and they also provide additional skills, resources and knowledge to a number of organisations to help them in delivering their construction projects. And given the fact that a number of our speakers today have already talked about the link between the public sector and the private sector, I'm sure that Peter will have something to say about that, and hopefully a few insights as well, maybe about how the COVID crisis has potentially affected the industry within Scotland itself. So Peter, it's your turn next.
Thanks very much, Andy. And I was going to start by saying I felt a bit like an imposter as a public sector person talking about the private sector pipeline, but I confess I now feel a little bit more like a target with all of the comments that Ian Edel and Ben have made on the public sector interventions that are needed to support that private sector pipeline. But I suppose my overall message is that I agree with that. It's not a time to see public sector this or private sector that. It's a time to see how everybody can work together to enable development and investment in infrastructure for the good of the country and for recovery. So what I intend to do over the next few minutes is to set out some of the areas where I firmly believe the public sector needs to be at this table of private sector investment, and really why I'm not just simply a week late for the public sector forum that you had last week. And a little bit more background, I have to say to this audience in particular that I am a civil engineer. I'm a proud fellow of the institution, but I've also been a financier, having spent 10 years at PwC. And as you said, again, I've now been in the public sector for 12 years since the inception of SFT, and took over as chief executive about 2 years ago now. Your point on the COVID impact in Scotland, I co-chair the Construction Leadership Forum in Scotland between the public and private sectors. And many of the attendees today will know that the position on construction in Scotland has been slightly different, in that we did have a pause in the industry's activity on site for a period due to COVID. I'm pleased to say that the work of the forum has been at the front of developing a phased recovery plan for the construction industry in Scotland, and we're now back on sites, and we're just out of a restriction that we had on using respiratory PPE. So now we're back into the sort of the same phase as the English construction industry on sites, which is not to say that the sites are without their challenges still. I think we all know that, and there's a lot of work still to be done. I'm pleased to hear people talking about the need for a shift in the way that we set up our commercial terms. I think that, you know, a lot of those have been found to have big risks sitting in places that we now don't think is the right place for those risks, and we can come back and talk about that a bit more if you want through the questions. Our role, as you said, is specific to Scotland. We're an operationally independent infrastructure centre of expertise. We are owned by Scottish Government. Our role is to help the public sector plan, innovate, finance, deliver and manage infrastructure more effectively. And as with all bodies in Scotland, our drivers are to improve the outcomes for the people and places of Scotland, places in particular important to us, with a particular focus on achieving net zero and delivering inclusive economic growth. And I guess that inclusive economic growth, which has been a leading feature of the economic strategy in Scotland for some time now, is kind of analogous to the emerging levelling up agenda south of the border. Our stakeholders are government and public bodies, so we work between central and local governments. It's an interesting role, I have to say. And also, critically for this discussion, the private sector, infrastructure and built environment, investment, development, advisory and delivery industries in the widest sense. We're there to span the gaps and build the bridges between all of these different bits of the sector that are needing to work together to create development and investment. So I'm going to sort of set out as a starter for 10 in the discussions 4 roles which I see the public sector as having a critical role in delivering the private sector pipeline. And the first of those has been talked about already, it's regulation. And what immediately springs to mind, of course, is planning and building regs. And there might be some near-term need for regulatory action, but I'm not one for knee-jerk change. And I would say personally that the public sector's role right now is principally in resourcing the system well and acting as an enabler through the system that exists already. I'm a big fan of community engagement and placemaking, so I'm not at all advocating shortcuts in that, but resource and focus is absolutely the key. But beyond that planning system, the regulation goes much wider, in particular in the transition to net zero, as Ben picked up on. And public sector regulation and incentivization will drive consumer and occupier payments, and hence the private sector investment for a lot of the infrastructure adaptations required to deliver net zero, whether that's on the generation side, or in particular, I'm thinking of building energy efficiency and heat decarbonisation, which of course should happen in that order: energy efficiency first, then heat decarbonisation, and EV charging and the storage and generation investments. Much of that regulation is reserved for Westminster. I certainly look forward to the outcome of the Treasury Net Zero review, which I hope is going to be a significant signaler to the long-term direction in that environment. The second area is enabling investment. So the public sector infrastructure investment often creates a platform for private sector development. It's a critical enabler, and the amount of public sector investment required, in all honesty, can change with the fundamentals of development economics. And following the global financial crisis, development waterlines change, and Ian's talked about that. It'll happen more in some sectors than in others this time round, I'm absolutely convinced. But I would argue that in the public sector, last time round, if you like, we were probably not quite nimble enough in reassessing what development needed an element of support and what could be wholly private. By way of an oversimplified example as to how the public sector enabling can help here, if the government invests £20 million in replacing a bit of a fally down school, then that creates £20 million of construction activity, which is absolutely fantastic. But if the government invests £20 million in a school that is needed for a development area where there's housing pressure, then that can unlock a whole series more millions of pounds in developing the housing assets and the place around that. So we really need to be thinking as a prioritization criteria for public sector investment, an assessment of the leverage of private investment that individual public investment can bring. And that's very much part of our approach as seeing public investment as an enabler of private. Thirdly is co-investing. So we've heard a little bit about that already, but investing alongside the private sector in assets, most likely as a minority investor, either as sort of pari passu or even as a first loss tranche or a guarantee provider. So in Scotland, we've cornerstoned, again, Ian was talking about this briefly, in the build to rent sector, a fund that Sigma are involved in. And there, that's a real signal of intent. And I know down south there have been the 5G and the electric vehicle charging funds that have been cornerstoned by the public sector. And for me, that introduces an interesting flip. This is public sector investment into private sector assets, which consumers will pay for. And that's kind of the opposite to PFI, which was private sector investments into public sector assets that government will pay for. But so an interesting change in the blend of public and private sector involvement in the financing, funding and development of assets. And I think it's an important area for the future. It shows intent and it crowds in private investment. My final point is critical one as a coordinating role. So putting in place a sort of ringmaster for the major important developments in a place, which is often a neglected public sector role. But it starts with setting the vision for the place. If you don't know and set out what your place is for, why should people come and invest in it? The role of a place and a single coordinated vision for that place, I find is really important, and a bit more, call it, if you like, muscular placemaking from public authorities, I think is a really important part of recovery. So it starts with that vision, but that's the pathway to making places investable. And it goes right through the planning process, liaising with utilities and others on major developments, being open for business, and even a sense of the planning system tends to permission, but maybe signaling even a prioritization within that system as to where we think the public sector focus is going to be, and therefore what might happen first and what might happen second and third. I think the public sector is sometimes a bit wary of indicating priority, but I think the private sector would often quite like to know if they're not first for the focus, they're second or third. And so it is a bit of a tension, but I think it's really quite important. And knocking down those blockers. I can't tell you the number of times that we've worked on a development opportunity where the promoters of that development think it's entirely obvious what the blockers to the development are. And the private sector people that own those blockers are frantically working away on something else. So that shared understanding and bringing people together a little bit more to work through the issues and being open for business in that coordinating, ringmastering way. What sectors do I think this plays in? We've talked about a lot of those already. The care sector is going to be increasingly important at that public-private interface, bringing private investment into that, I think. Build to rent, we've heard about from Ian. But the affordable side of build to rent, I'm particularly keen on. I think it's right for private investment in more affordable build to rent with some public intervention, perhaps. Heat networks, we've heard about energy efficiency, as well as the more obvious generation and storage side, which is a little bit more entrepreneurial and will probably require some more sort of private equity type infrastructure investment as opposed to the traditional stable long-term investment. So there we have it. That's my view, if you like, on the public sector role in enabling private development pipeline through regulation, enabling investment, co-investment and coordination, focusing really importantly on making projects and places investable, not on seeking investment. My experience is that investment will find investable places and projects. Thank you very much. Happy to take any questions.
Thanks very much, Peter. That was really interesting. And that what you finished on there, I think is actually quite a good watchword, really. Making projects and places investable is something that I think we do need to bear in mind. Just want to kick the discussion off, first of all, with a sort of a broad question, really, looking at the whole sort of issue. And that is, given the fact that, as Edel said, the private sector was quite likely to bear the brunt of any economic downturn as a result of COVID, what do the panel think are likely to be really key growth areas that ought to be absolute, no-brainers really going forward from the point of view of people looking to invest in this sector? And if I can start with, I mean, I know Ben has mentioned some of the green recovery, and we'll come back to that later as well, and he may well talk about it now. But if we can just start with Ben, what, if you were advising private sector clients, and I know you do, what would you say? Well, actually, look, you really need to be looking at this particular area, notwithstanding all the difficulties that we actually have.
I think you're on mute.
Thank you, Peter. Yeah, no, thanks, Andy. I was just saying that it covers a lot of the sort of sectors I've already mentioned. In terms of from my perspective, I think energy storage is probably a critical one at the moment, and also from a it's been removed from the NSIP regime, so it should make consenting easier, which is a big change by government. And we may well see more projects coming forward rather than the slew of 49.99 megawatt projects we've had. We may finally see 100 or 200 megawatt scheme delivered, but also emerging technologies that have a proven track record. As I said, pump storage, whilst the problem with pump storage is the most efficient storage mechanism at grid scale in the world, and it's a proven technology. Problem in the UK is the market for storage technologies at the moment is based on a very short sort of time frame, so it's 3 to 5 year contracts, whereas a pump storage scheme needs a longer term than that to make the investment stack up, because the capex up front is massive. But there's increasing interest, I've seen anyway, in pump storage schemes going forward, and there's increasing dialogue within the government that they're starting to recognise the contribution they could make. And if they want 40 gigawatt of wind offshore, they're going to have to find a storage mechanism that works with that.
Thanks, Ben, for that. Ian, your comments on what you think ought to be absolutely bankable areas in the public sector. I mean, many people on this call will be thinking about, well, yeah, there's going to be a bit of a dip, a bit of a downturn, but what are those areas that are going to hold up, in your opinion?
I think one that clearly I focus on is housing, and I think that applies across the whole housing sector. Peter had mentioned affordable housing. I think there has been certainly disappointment so far at government announcements in terms of support of affordable housing. It seems a prime opportunity at the moment to ensure that we're given shortages, particularly in the delivery of affordable housing, that we should be trying to find funding to support more delivery of that. But clearly the build to rent sector, which I mentioned, was a child of the last recession, and government had wanted to diversify housing delivery and have a product that was counter-cyclical, and that demand for quality rental accommodation at whatever price point, I think, is strong, and the sector's actually come out, I think, of this crisis very well, in terms of if you're looking at numbers of people that are trying to access the sector in terms of customers, that bounced back very quickly. Clearly people are not satisfied with their existing housing and wanting to find something, particularly in the private rented sector, that's a bit better. So that would be certainly one of my focuses.
Okay, thanks, Ian. Edel, from your perspective, where are you looking as a company for those areas that are either going to hold up, that are going to come back, or even the new ones?
I mean, absolutely support what Ben and Ian have said with regard to renewables and certainly housing. I think one of the challenges is investability for return to deal or in the future is one of the choices investors have got to make. And certainly, as Ben was talking about, the pipeline of assets that will respond to a greener agenda. And if you think about commercial developers right now who already have been moving over time into more build-to-rent opportunities, is a good example. What will they do with their existing asset portfolio? And retrofit and the green credentials of that will be a key part of that. Certainly those areas where we still need to sustain for the system, whether it's health and education, they need to be maintained all the way through that. But I think the final point really is what Peter was saying about place and regeneration, and that's why I'm saying there's the immediacy and then the long term. I think regeneration, particularly when you look at all of the public infrastructure going in, particularly around high-speed rail, etc., how we're going to connect concurrent investment to building the means for people to get from A to B and then have a place to go and have an experience, live, play, learn, whatever that might be, is a really important area that people are looking at, but balanced on how long they want the return on their investments to come back on and where their investment's coming from.
Thanks, Edel. I want to ask you something else later on, and you may or may not be able to answer it, because I think, that obviously this has been a global crisis, and it'll be interesting to potentially get some of your insights, working for a global consultancy firm, but that's a bit for, for later on. I think you've essentially queued up people, Peter, there really, in terms of, coming back to this issue on place, which I think is really, really important. I mean, next week's webinar, we're going to talk about what will infrastructure look like and construction look like post-COVID. So we don't necessarily want to have that discussion now, but, coming back to, what you were saying there and posing the question, perhaps in a different way to, to Peter, to just reflect on that importance of place and joining everything up, on this issue. I mean, is there enough coordination? Are we joined up enough to make sure that the private sector can actually get involved with what the public sector wants to achieve, in your experience? Could we do better?
Well, I think we know the answer to that question, don't we? Yeah. We can always do better, and it's not good enough. But I think that the really tricky thing about place, which we sort of we bang the place drum. We've banged the place drum for a while now, and we have a place principle in Scotland that's been embedded across the public sector. But when you're speaking to colleagues around the rest of the public sector about place, it implies a sort of matrix, because the way the public sector generally thinks about itself is by the big portfolios of service, whether it be health, whether it be education, whether it be economic development. And people like us bounce around and say, oh no, you should think about a place. And then we say, but sometimes a place is a street, and sometimes a place is a town or a village, and sometimes a place is a city, and sometimes a place is a region. So we're almost saying, I'll see your silos of service, and I'll raise you a set of cross-cutting place that we can't even say it's got firm boundaries. It operates at different levels: national, regional, local, micro. And so my view of it all is that we need to go really gently into this and not try and change the world, from the public sector world, from being a sort of service world to being a place world overnight, but introduce a place overlay in all of our thinking. And that makes it even more difficult in a way, because we're not saying change, we're just saying add. And so part of my point here, I suppose, is we have to embrace the complexity of it all. And this shovel ready versus shovel worthy, things are difficult. We can't pretend that you can make an easy intervention that will make a big difference, because if there was an easy intervention that could have been made to make a big difference, it would have been made already. So there is a level of complexity in the thinking that's needed. That doesn't mean there's not low-hanging fruit and there are things that can be done. Of course there are. But we also have to embrace doing the difficult things and bringing the people together to do the co-production that's needed to get these sort of place agenda and the difficult things done well. And I know that's not sort of an answer to a question. It's sort of seeing your question and raising it again. But I honestly think that is the answer, is to embrace the complexity and to invest in the capacity and capability necessary to resolve it. We can't do all of this through capital investment alone. A lot of it requires capability and people in the right places with the right skills to do this planning and development work that we've talked about.
Thanks, Peter. I want to explore this issue a bit more, actually, because it immediately strikes me around the whole thing around place and around the response to this crisis. Just listening to the radio this morning, as you do, and there's talk of potentially going forward giving local areas much more power to impose local lockdowns. Now, I don't necessarily want to talk about local lockdowns, but it immediately struck me about the regional sort of influence and the actual, the involvement of local areas in all of this, in COVID recovery, and particularly, the recovery of this sector and this industry from what we've actually seen. We've seen a lot of national announcements of late, but to me, it doesn't seem like there's been much coordinated involvement from some of the regions, whether it's the elected mayors and all the rest of it. And I sense a real possibility going forward of there being much more of a role for the the local areas, which maybe runs counter to what potentially this government have originally hung its hat on, perhaps, or maybe their views are having to change as a result of what we've seen. I mean, sign of a more regionalized approach to to investment, to solutions coming out of this crisis. And have you what have you detected from some of the survey that you've done of your members in that respect?
Sorry, Andy, you broke up a little bit in the middle of that. I didn't catch the whole question.
I'm just asking about the regional impact of all of this. Are we involving the regions enough? And when I talk about the regions, in the first instance, I'm talking about the regions of England. Obviously a number of those have got elected mayors. There's a wider issue as well when we look at Scotland, which is obviously a separate country. But is there enough focus? I mean, obviously Scotland's got it because it's a separate country. But do we have enough of a regional focus? Are we involving those regional political structures and organizational structures enough in all of this?
Yeah, certainly it varies from some of the core cities at the moment. Certainly activity that I've seen from the Mayor of Greater Manchester and also Birmingham, and we're involved in some groups looking at how to stimulate demand going forward. I suppose, picking up Peter's point in terms of that sort of enabling, a huge fear, not so much at regional, but at local level, is just the resource constraints at local level, and the local authority finances were in a poor state before this crisis hit, and you hear almost daily reports of local authorities that just are so constrained by current sort of revenue that they're bringing in. So and things like planning tend to be one of the first areas to be cut. So, but I think there's a role sometimes for the private sector as well in terms of reaching out and for us trying to ensure that we are supporting that as much as possible. Can we provide some resource to enable that? It's fraught with sort of conflicts of interest, but if you can put in place those structures that allow my members, on the whole, I think over the last two iterations have supported, for example, increases in planning fees, because at the end of the day, they know if they want to do things that there has to be that resource at a local level. At the regional level, I think the other big constraint is just the variety of powers that have been devolved, and there are key things that government could probably push harder on. So strategic planning, isn't varies significantly across a number of the combined authorities don't have that power at the moment, and also things like skills, devolution of skills budgets is not something that many of them have, if any, I don't think.
Thanks, Ian. Edel, over to you. I mean, what's your view on the regional situation? Do you see any different approaches region by region? And maybe now's a good point as well, potentially to bring into some of your observations around, you know, on a global basis, if you feel that you can actually do.
Yeah, so I'll start with the global, because I was thinking about, well, what are we seeing? And I think the singular word that would sort of demonstrate which are the sectors and markets that are moving is where resilience is paramount. Resilience for existing assets, or indeed resilience for the future state. So whether that is under renewable energies, whether it's about climate resilience, whether it's around the asset and how the asset is used in the future. And certainly when I look around the creative technologies, data centers, logistics, the capacity increase, and you talked, I think earlier, Ian, about Amazon and how much logistics space is being taken up in the UK, that is a phenomenon that sits well outside of just the UK in terms of edge logistics that's coming into play and edge data centers. So actually recognising, while COVID as a singular event has caused us to do something, it's, you know, that response that we've come to is part of the long game that we probably had to get ready for. And those industries and sectors are certainly focusing quite clearly with their investments, not only to sort of say, does the asset or the natural asset stand up for today, but is it future proof, and how does it help us on our net to zero carbon journey as well, in the balance of all of that? So they are definitely the themes that sit around the global portfolios. In terms of the UK particularly, and the regions, and we work with lots of different local authorities and then with the private clients, what we were talking about pre-COVID-19 was alignment to the government's industrial strategies and how different local authorities were responding to that, and helping our private clients sort of connect the dots of what was going to be important in that region or that locality, and therefore was it investable in terms of prioritisation of their portfolios. And I still think that remains really important. And when we get the reviews that are coming later this year with the budgets, etc., because that's part of the challenge, right? Where do people put their cash right now, both the public purse and the private purse? That is fundamentally the challenge. And we've talked a lot about certainty, and whilst we are in uncertain times, having clarity on the things that we're definitely going to do at pace allows people to make more collaboration that Peter was talking about, and coming together about the solutions rather than the what ifs. So I think that's our big challenge that we have right now.
Okay, thanks for that, Edel. I've got a question, and I think it's one on excuse me, on the green recovery, really, and this is from Chris Thompson, and he says, regarding existing building stock, what incentives are required to encourage investment in energy efficient improvements to private sector buildings to support net zero goals and deliver a construction pipeline? So, you know, do we need incentives in that area in order to encourage that kind of investment? And I'm going to ask that question first to Ben. Have you got any thoughts on that?
Yeah, I mean, I think you do need to incentivize it to a degree. It should also, I mean, saying that, though, you see an increasing movement now, particularly among some of our clients, towards doing it for themselves because they realise the benefits, and it ties in with the CSR obligations that a lot of firms have. And you've seen a lot of the consultancies announce, the multi-disc consultancies announce net zero by 2025, 2030. So I think it's people are taking it on board, but obviously there will be some who don't, and they may be where the incentives are needed.
Thanks for that, Ben. Peter, you might have a different view on that. I don't know, but your thoughts? You're looking to come back on that?
I mean, I think it's going to be carrot and stick, and the important bit will be to place the carrots and the sticks in the place to get the just transition that we're all looking for. And it's going to be complicated, but the obvious point to catch a building is at a transaction point, because the asset has value at a transaction point that's crystallized, and some of that value can be used to increase the energy efficiency of that building at that point through a regulatory intervention in a form of sort of stick way, if you like. And some of the points we've made on that we've seen coming out from the government on homeowner grants, that will be the carrot side of things. So for me, the important part of all of this, I'm really big on energy efficiency of the building stock. I think it is absolutely critical. It's a low regret investment, and it needs to cover domestic and non-domestic. And it's a precursor, as I said before, to heat decarbonisation, although a lot of it will happen in parallel. So getting that mixture of incentive and regulation right at the UK national, the devolved national, and the local level is the challenge, and the timing all of that I know has been worked through by the sort of policymakers at the minute. I think that's something that needs to be accelerated, because it's an area ripe for investment. It creates lots of jobs, local jobs. A high proportion of the capital value is relatively low skilled, quick trainable people, and so we see it as an important area, and one where both regulation and incentivization will be needed, with that view to just transition and quick jobs. So I know, again, that's not an answer, but I think the pathway is there through the policymakers and the regulation. It just needs accelerating a wee bit.
Thanks, Peter. Ian, do you have a view on that in terms of existing building stock? Do we need more incentives in order to encourage that, or should it just be happening anyway?
I agree with Peter. It's a combination of incentives and disincentives. And on the disincentives, the thing that our members always cry out for is clarity in terms of they're long-term investors. They want to see a long-term trajectory that they're working towards. If they know that, then they make investment decisions on the back of it. In terms of incentives, clearly there are a number of levers you could use: VAT, capital allowances, SDLT, business rates. I think sometimes government looks at it in terms of too blinkered and sort of says, we'll have a green initiative, rather than thinking about the existing initiatives that it's got and greening those. So, for example, the SDLT announcements over the last 2 weeks, if government had wanted to, could have been linked to some sort of green improvement target for those that are transacting their homes. And so I think it's, what I'd like to see more from government is sort of it's stitching, almost green measures into almost all the interventions that it takes, because that's the only way we're going to get to, I think, the ambitious targets that we've got.
And no halfway houses. So we don't want to see an incentive for something that you have to do in 5 years, that you have to do another thing in the next 5 years to get all the way there, if you like.
Just on that though, I mean, in what you said there, about linking, sort of green investments to other things, you're not the first person to have said that. I've heard that a few times, and I've heard it as well from people in the industry who kind of lament what the government has done in some cases and say, well, it's great we're getting, these promises, and obviously they've got to come to fruition. However, why aren't they doing that more overt linking and really pushing the boat out in relation to properly promoting a green recovery? I mean, I know we've had the words, but has there been enough action as far as that's concerned? Because, the Committee on Climate Change have made the point in their most recent report that we have a once in a generation opportunity. I've heard that phrase in relation to a number of issues. So we're either going to have a lot of generations, or we're not going to actually deliver on some stuff. I mean, is our industry, is our sector vocal enough in actually going to government and not meekly just accepting what they say, but actually engaging them properly? And because at the end of the day, surely we're the experts, aren't we? Do we engage enough on them? Are we at the top table influencing these decisions to the extent that we ought to? And I'm going to ask that question firstly to Edel, because I know that Arcadis are involved in all sorts of advisory roles in different places. Is the industry getting its voice heard, Edel, in your opinion, enough?
Yeah, so I think, right, there are places to go and have a voice, and certainly as a global business, we're pretty proud of what we can bring to the table, particularly with our Netherlands heritage. We've got a pretty good track record there in terms of resilience in its broader sense, and indeed we bring that knowledge across here and have been engaged with government, sharing what that country has done and what we think is relevant to the UK. I think the point is about the connectivity, right? So there are different forums and different voices that can be heard, but the knitting of it all and actually it coming out as something that is both comprehensive and connected is the challenge. So my view, there are forums to go and get connected to. There is engagement, but actually the important part that probably isn't strong enough or we're not seeing visibly enough is the connecting. And we've talked about that, whether it was the part L and part F that's coming. It's the whole sequence of events. Can I just go back to incentives though? I think there's a really important community that we've not mentioned that I think is the biggest incentive of all, which is the consumer. And I think the demand from the consumer, both in occupation or in use of assets that are performing to what we see as the needs of the future, will expedite some of the challenges that we have in the industry. Because the consumer, and we look at house building as a really good example, they are definitely now making choices about the homes that they will choose to live in based on the offer of that assets being built to.
Thanks, Ed. Ben, just your view on that. I mean, I know your organisation, Barton Willmore, and I've seen, the research that you've done in a whole series of areas, and it's all solid stuff. It's great stuff with some fantastic ideas. But how do we ensure that we get that across properly to those people who are actually going to make the decisions at the end of the day? I just think sometimes we're a bit too timid in actually saying what we want.
Yeah, I mean, there are sometimes it's difficult to get into the right people, but there are a range of ways and means of doing it. I mean, we tend to work closely with industry organizations wherever we can. So the recent research we've done on whether a new regime is needed and a national settlement strategy should be produced to deliver new settlements within the UK. We've been talking to people like the National Infrastructure Planning Association. They have connections with government. We've also been talking directly to MCHLG about the report and the findings. And it's engaging directly seems to be the only way to do it. I mean, I'm a member, we're members of Renewables UK, and I can safely say that as an organisation, they engage with the government very effectively throughout both England, Wales and Scotland, throughout their membership. And it's just about having those relationships, I think, and building those up over time. But again, it's still sometimes you could put all the research in you want, and you don't always get listened to. But I think you do need to have those connections and those relationships to start with.
Peter, you've spoken eloquently about the need for more coordination, about the need for partnership, and you've obviously experienced that in your day-to-day work. I mean, do you think that we do need to be doing more in this area, that the government do need to be hearing the voice? I mean, maybe you've got it perfect up the road in Scotland and everything's, a land of milk and honey. I don't know, what advice could you give, from your position in the sector?
Well, so I'm relatively privileged position in that I speak to ministers regularly about these things, but I suppose, and I would give some reassurance that the industry's voice is being heard, but the challenges are those exactly that everyone's been talking about, have been joined up in that, and just by way of example, there is an education minister who's really interested in schools and education, and they have a budget to spend on schools and education, which is fantastic. And influencing that budget to get it spent on low carbon schools and education is not something that the people in the education silo that report to the education minister that do the education thing will be trying to do. So this move towards outcomes, away from the silos of delivery and those interests is just plain difficult. So I would say we're doing the right thing, or you're doing the right thing to influence. As more people saying, my one sort of advice is, as more people saying the same thing rather than slightly different things from slightly different perspectives would be really useful. because the energy it takes to reply to everyone and respond and sift out the good, bad, and indifferent ideas is significant, and there's not that much resource to do it, but it is being heard. I think things are changing for the better on that joining up front, but I would very far from say it's perfect at the minute.
For that, Ian, did you want to come back on something on that?
I just wanted to say on the previous conversation about sort of green agenda that actually sometimes what I see from our members is that there are bigger forces at play here, and Adele's mentioned one, which is customers, but the other huge influence on our members is the big global pension funds and how they're allocating their funding, and they are increasingly not going to invest in a second-rate knackered portfolio of accommodation. That is the questions that our members are asked about their portfolio increasingly are about its environmental performance, and that is because those asset allocators don't want to take risk, either risk in terms of reputation or risk in terms of the future operational performance of those buildings. So national governments to some extent are one driver, but by no means the most important one, I think, going forward. And the sector's ambitious. So we did a survey a few weeks ago of our members' intentions on their spending on sort of green infrastructure, and whereas previously, as I said, 30% in terms of reduction in spend. We asked them about their intentions on green infrastructure. Not one was intending to slash their spending on the green infrastructure, and that was a sample of about 30, I think. So I think the intent is there, as you've iterated, Andy. Perhaps sometimes that's not as well articulated to government as it might be in terms of them understanding that we're not a blockage to their ambitions, we're an enabler of it.
Okay, thanks for that, Ian. We're actually reached the point in our webinar where we've got the last question, and I always try and think of an interesting last question that kind of puts our panelists on the spot, and today is no exception. The question I want to put is, if you were in charge of everything, I mean, obviously Peter is in Scotland, but if you were in charge of, and you had a magic wand and you could wave it and do something that would really influence the private sector pipeline for infrastructure, what would that be? And it may well be, you would announce a particular piece of major infrastructure that was going to be built. It could be anything. What would you do with that wand to basically create the certainty that everyone wants to see in the market? And first of all, I'm going to go to Ben Lewis, because he looks as ready as anyone else. Ben.
Looks can be deceiving, Andy. Having had no time to think about this at all, I mean, I think going to what I know, then my magic wand would have to address national planning policy and the uncertainty that sits within that at the moment. We're seeing an increasing number of challenges, particularly from the infrastructure side of the stuff that I'm involved in. Court challenges to the national policy statement on energy, national policy statement on national networks and highways, which are creating uncertainty. I mean, the government has a problem in that to review an NPS, they need to put the current NPS sort of on the back burner, as it were. So they're in a difficult position where they're being asked if they should be reviewing these documents, and yet to review one means the current one's pulled out of circulation, which means policy uncertainty for 12 to 18 months while they come up with a new version. So there's work to be done. My magic wand, would be to update them all and instigate a regular and efficient 5-year review cycle.
Okay, thanks for that, Ben. Ian, your magic wand, where would you wave it?
Firstly, I'd support Ben's. I think there are a number of changes you can make to national planning policy framework. That doesn't take too long, just some period of consultation, and so that's a quick win, I think, from government. The one I was going to say, and it's exceptionally boring, but sometimes the boring ones are perhaps the best, and we've mentioned it already, is to have that additional resource within local authorities. the challenge in that is not only getting the resource in, but just finding those people that are out there that can support particularly the planning process in local authorities.
Thanks for that, Ian. Peter, your magician's implement, where would you wield it?
Well, I'm not going to change what I was going to say based on the two previous comments, but I was going to say a national plan by sector to get to net zero that signals what's going to happen where, and then the clear intent to regulate and incentivize to get there, to signal to the industry where that investment is going to be needed and show the pathway over time. And I was also going to say, and local investment in capacity and capability for muscular local placemaking at a local authority level that really can understand and drive what that place is for, and interact and do that sort of, call it ringmastering, if you like, of the developments that will enable that. So that was two things. I apologise, and it's the two that have been mentioned already, which is kind of good in a way.
That's fine. That was even though there was two things, that was succinct and that was brief. And here's someone else who's going to be equally succinct and brief.
I will.
Basically round it off, and that's Edil. Over to you.
Yeah. So on the basis we get all of that, we've got to think about how we deliver it. And so for me, and that's a really important part of policy. It's one thing to say what we want, but thinking about its deliverability is crucial. So I would want to see built into that a real foresight and engagement from industry about how you deliver that, and particularly recognising all the challenges that sit post-COVID-19 in contracting and risk allocation, real focus on that so that we can have great ideas, great policy, and actually make them implementable.
That's excellent. Thanks very much to Edil for those remarks, and indeed thanks to all our panelists today for their contributions, to Ian Fletcher from the BBF, to Ben Lewis from Barton Willmore, and to Peter Reiki from the Scottish Futures Trust. I think you'll agree that we've had some very interesting insights actually from the panel. And just one thing in finishing today's event, I think it's we've started a discussion here, not just on the pipeline, but also about how things are going to shape up for construction and infrastructure. And I think it's really appropriate, therefore, that next week's Infrastructure Intelligence Friday webinar is going to be looking at infrastructure after COVID. What will it look like? And we know from the registrations for that event that people are very, very interested in that particular issue. It is a big issue, and one that all those involved in our industry shouldn't miss. So please, do register for next week's event. I just want to thank again all of our panel for their involvement this morning. A big thank you as well to Barton Willmore for sponsoring our Infrastructure Intelligence webinar series. And thank you to you, the audience, for taking part and for listening and watching in. And I hope you all have a great rest of Friday and an excellent weekend when it comes. So that's it from me, Andy Walker, the editor of Infrastructure Intelligence, and hopefully see you next week for the latest in our Infrastructure Intelligence webinar series. Everyone's going to wave bye-bye. Thanks very much, and we'll see you again soon.
Thank you.
Thank you.
Thanks, Andy.